Now stand aside, worthy adversary.
'Tis but a scratch.
This is a clip from a previously recorded full-length episode. Please visit milkshakespod.com for more information and access to the full-length original recording.
Let's talk a little bit more about, the price of bonds and how this is influencing the strength of the dollar and where this is already starting to show up in overseas markets.
Sure. So I think the best way to address this is to talk about, I think many times when people hear me talk about the dominance of the dollar or the fact that the U.S. is still the strongest country in the world, I think they automatically assume that that also means that Treasury prices can't fall. U.S. Treasury prices can't fall. But that is simply not the case. And for my theory to play out, and whether it will or not, we'll see. But I don't need U.S. Treasury prices to rise for my theory to play out. To be honest, in either scenario, in a highly inflationary scenario where interest rates rise, that's actually pretty good for the dollar milkshake theory. Or in a scenario where we get a massive deflationary event and everybody rushes to the safety of U.S. Treasury, or at least the perceived safety of U.S. Treasuries, and the price of Treasuries rises a lot and the yields fall a lot, that would probably be good for the dollar. But under both of those situations, it's good for the dollar. And it would really only be a return to normal and a Goldilocks scenario where we have kind of synchronized global growth that would be bad for the dollar. Because under either of the other scenarios, it's good for the dollar. And here's the reason why. Is as bond prices fall, and listen, U.S. Treasury prices are down like 30 to 35% over the last, 1.5 to 2 years. That's a huge drawdown. But it's not a huge drawdown when you consider what the Fed has done with interest rates. We talked about this last week or 2 weeks ago, and we compared it to previous rate hiking cycles, and what's happened with the U.S. Treasury is very much in line with what happened in previous rate hiking cycles. So this is not a big shock to anybody who understands bond math. But the reason that as bond prices has fallen, that the U.S. dollar has pretty much gone up in correlation with it is because everybody needs dollars to operate on the global stage already. We've discussed this many times again, and it doesn't matter if you think it should or not, it's just the way it is. And if you already have to own a certain currency to operate on the global stage, and now you also get paid a lot more to hold that currency than you get paid to hold a competing currency, it makes the decision even easier than it was before. So in other words, when big global allocators or when big global dollar receivers receive those dollars, and they need to save them in order to buy oil or buy other import costs or trade on the global stage, they save them in the form of U.S. Treasury bonds. Now, they may decide to hold those in short-term T-bills. They may decide to hold them in U.S. agency bonds. They may buy the 10-year bond, or they might buy the long bond. It all kind of depends on what exactly it is they're trying to accomplish and over what time period they want to hold those savings. But that is the form in which they hold their savings. Now, again, you might think that they shouldn't. I'm just telling you that's what they do, whether you think they should or not. So as a result, when somebody has these dollars and they have the choice of, and they know they're going to need dollars in the future, they have the choice to hold the dollar and get paid 4.5%, or sell the dollar, go buy another currency that may fall versus the dollar, and then buy a bond in that currency that's paying less than the U.S. bond, right? So the point is as the U.S. dollar gets stronger and people want to hold it, they don't want to hold their own currency, which is falling versus the dollar, and they want to put it into something, and then they don't just leave it in cash, then the fact that the interest rates are going higher in the U.S. makes it even more attractive. In other words, it makes the bonds even more attractive when they're cheap than when they're expensive. It's like if you're out buying a Ferrari, and you see two Ferraris, they're the exact same. One of them costs $100,000 and the other one costs $200,000. You're going to buy the one that costs $100,000 because it's cheaper, right? And so it's kind of the same thing. You get paid more, or if you're buying two stocks, they do the exact same thing. They have the exact same growth potential, but one pays a 5% dividend and one pays a 0% dividend. you're going to pay or if you're putting your money in a bank and you're going to go store your money and you're going to put it in a savings account, do you want to put it in a savings account that's paying 5%, or do you want to put it in a savings account that's paying 1%? So again, that's why lower bond prices actually are a benefit to the strength of the dollar. It's interest rate parity, or is a way to think about it. All things being equal, the bond with the higher interest rate is going to be more attractive. And so but in order to buy Treasury bonds, you have to buy dollars. So you either have dollars and you're buying bonds, or you have to buy the dollars in order to buy the bonds. So it's just that is why lower bond prices are actually a strength for the U.S. dollar. And this is, and going back to the milkshake theory as a whole, is that, and I want to be absolutely clear about this, is this theory does not say the U.S. will not get hurt. The U.S. will absolutely get hurt in this theory. Everybody, in a global crisis, nobody comes out totally unscathed. So everybody's going to get hit. And so it's not a question of who gets hit first. It's not a question of who gets hit the hardest. It's really a question of who survives longest, despite taking all the hits. So it's really about who's the last person standing. And I just believe that out of all the countries, the U.S. will be the last country standing for a number of reasons that we've discussed many times. So the fact that U.S. Treasury rates are going higher and we have to spend more to fund the government, to me, does it hurt? Yeah, it hurts a little bit, but it doesn't hurt us as bad as it hurts the rest of the world.
Yeah, I mean, the dollar milkshake theory, using these different movies to visualize the idea overall was an excellent approach to it. I'm just surprised now that you're talking about it in the context of, given how much confusion often comes with people's interpretation of what you're saying. I'm surprised you didn't, add Rocky in there as the last man standing, because everybody ends
funny.
Up. Mm-hmm.
Yeah, well, what's funny is when I kind of first started talking about it was back in 2018, and the Fed was first starting to raise rates after years of having them low, but rates were still very low. So nobody really gave a lot of thought to higher rates because they just weren't a reality at the time. But now, 4 years later, when rates are not at 1% they're not at 50 basis points going to 75 basis points, right? They were at 1.5% a year and a half ago. Now they're at 4.5% or 5%, depending on which bond you're looking at or which rate you're looking at. So now you're back to a real interest rate, and now it's very visible. And so it's funny to me when people, back when I first started talking about this, people would say, well, the rates aren't that high and the U.S. isn't going to raise them very high, so it's not going to work. And now the rates are higher, which is kind of where I said they would end up being. They're like, well, it's not working because bond prices are falling. Well, okay. You can't have higher rates and higher bonds. It doesn't work that way.
Yeah, classic. Your basic understanding of bonds, should be researched before battling that part of it. But the other thing too here is worth talking about is, how do I set this up for you? You have, when you need to acquire, like maybe in your wallet you've got $20, $100, whatever. You're not carrying around a lot of cash. But if you're a government, a sovereign nation, and you need to be able to play on the global stage and you need dollars, you're not walking around with, a shipping container full of dollar bills. The way that you're storing that liquidity and that collateral, that liquidity is through the Treasury bonds as the collateral. But what's really interesting, we kind of did a flyby on this at one point, but we didn't necessarily go as deep as I think maybe we should and we've even wanted to, is that if you are, let's take China, for example, a nation that's for some time hedged its need for dollar liquidity with, holding a large supply of Treasury bonds that you purchased over the last decade at relatively much higher prices than where bonds are at now. For you to sell those bonds into the market to get the dollar liquidity that you need, you're actually taking a big haircut. And I don't think there's enough credit given to the kind of weaponization of Fed policy unintentionally and intentionally when you consider those types of dynamics in mathematics.
Yeah, and see, this is the argument that I have. Part of the reason that I've pounded the table on the dollar as hard as I have is not because I think it's a good system, but because I think the system is dramatically misunderstood. And I think there's an element to it that even those that understand it just don't want to admit that's real. And that is that the fact that the U.S. can literally use it as a weapon. And what makes it even harder to accept is there's a duality to it. And what I mean by that is the U.S. can't just out of the blue, if we were in a depressionary state, we could not hike interest rates to 5%, right? But the fact that we're in a little bit better shape than everybody else allows us to do it. And so when we're hiking rates, we're able to do it. And because we have high inflation, we're able to do it under the guise of U.S. domestic monetary policy. Listen, we're just taking care of our own domestic economy, which is what our mandate is. Okay? Well, that's absolutely true. But perhaps they could have gone slower. Perhaps they didn't have to go from 1.5 or was it 50 basis points on the federal funds rate to 5.5% in 18 months. Perhaps they could have done it over 2 or 3 years, or perhaps they could have gone from 50 basis points to 350 basis points. But the fact that they can when they do this, the fact that it hurts the rest of the world, it's almost like a stealth weapon, right? And who's to say that the last 200 basis points of hikes were purely for domestic purposes? Maybe the first 250 basis points were for domestic purposes, and maybe the second 250 basis points were kind of a stick in the eye to the rest of the world, And thing is it can't be proved. And many people will say, "Oh, you're ascribing malice to something that's really being done for the altruistic reasons domestically." Well, maybe. But what I know for sure is that in 1993, I think federal funds rate were at like 3%. And by 1999, federal funds rate were around 6%. And in that intervening 7 years, we had the Mexican bond crisis, we had the Asian currency crisis, and we had the Russian debt default. So, is it totally coincidental? Maybe. Maybe not, right? And even if it is 100% coincidental, it doesn't mean that it can't be used offensively. So this is, it's monetary policy is basically a defensive mechanism to protect the domestic economy. But a very good defense can be used offensively. Deion Sanders is a perfect example. He was a defensive back, but he scored a lot of touchdowns, and he hurt the other team quite a bit. And I think anybody who had him on his team would say he's our best weapon, right? So and again, if there wasn't this duality to it, it would be much more obvious that it was being done, and the blowback would be much more severe. But the fact that there is this stealth kind of duality to it where it's not quite clear why it's being used, it makes it that much more effective, and it makes it that much easier to defend, for the U.S. to defend its position. And so, I've kind of gotten to the point where I don't care whether people see this or not. I want them to see it, and the reason I've pounded the table on it is because I want to help them, but I can't make people believe, right? But I'm telling you, it's possible to be used this way. Maybe it's never been used this way before. Maybe it never will be, but it's possible. And I think that as we move forward in this, geopolitical Game of Thrones that we've talked about, I think every option and every weapon is on the table. And I think it is being used, and I think it will be used again. And I think it's very important to understand that it can be used this way. And so for anybody who's not familiar with what we're talking about, the fact that the U.S., if everybody is this is what John was referring to. If somebody let's say you have $1 million and you put that in Treasury bonds, and that's your savings account for a rainy day. And you did that when interest rates were 1%. And then now all of a sudden, the Fed has hiked rates dramatically in the United States, and now interest rates are 5%. And in that time frame, the 10-year bond that you bought originally was yielding 1%, and now it's yielding 4.5%. That means that the bonds that you owned are down dramatically. So your $1 million is now worth, $800,000. And now it's things are tight out there. You have to tap your savings account, right? Well, the U.S. is saying, okay, yeah, go tap your savings account, but there's an early withdrawal penalty. If you hold it to maturity, we'll give you all the money that you put in. But if you don't, if you pull it out early, there's a withdrawal penalty. And the withdrawal penalty is pretty stiff. It's 20% or whatever the number is. And so it's kind of this very ingenious system, for lack of a better way of saying it. It's just, it is the way it is. Now, and some people will say, well, it wasn't designed for this. It's just, so it's a coincidence. And again, listen, I don't care whether it was designed specifically for it or if it's a coincidence. The fact that it exists is a fact, and it can be used as such. And so as people and institutions and entities around the world get into these economic crises, typically when their revenues are down as well, and they have to tap their savings accounts, they're tapping their savings accounts typically at a withdrawal penalty time period. And so that and that fact kind of reinforces the relative strength of the United States versus that entity. And I just think it's very important to understand that dynamic.
Yeah, the stealth duality, I like that. We did an episode, I think now 2 weeks ago, called The Great Fall of China. And we were kind of highlighting as a core part of that conversation, some of the chart crimes that were going on around the specific amount of activity that was going on with China and China's bond holdings. And the picture that people were trying to paint was, oh, look, China is dumping bonds, when the reality was the net asset value of China's bond portfolio was rapidly declining. So in essence, their purchasing power that they thought they had, hedged away, had eroded at a time when they needed it most, because they're going through all kinds of issues in their domestic economy at the moment. So it's a nice correlation between that episode and kind of this stealth duality weaponization. But also to reinforce your point that it's kind of that Rocky analogy of, Rocky might have lasted the whole fight, and maybe, he even won in the later movies, but not without getting a bunch of black eyes. And so in this environment where the Fed is raising rates under, maybe it is a guise to control inflation. Maybe they're more aggressive than some might think they should be for geopolitical reasons. But as a result, you end up getting the pain that you've been discussing, but you also end up getting real yields. And when real yields start to reach the point that they're kind of at right now, which is this 2%, and they start to creep above that, it's not just, the Mexican peso crisis and the Russian ruble crisis. You start to get, major economic events in the U.S. as well. So it is kind of a game of, Russian roulette to some extent.
Yeah, and think about this, John. Think about what happened 18 months ago now. So 18 months ago, Russia invaded Ukraine. And in response to that, the United States and much of the other Western countries decided to kick Russia out of SWIFT and confiscated billions of dollars in Russian assets. And I don't remember the exact number. I think it was $500 or $600 billion of Russian assets, of Russian reserves. Literally money. They stole their money. They took their money, right? And that was hailed as a horrible decision on behalf of the U.S. And I tend to agree. That is probably, when we look back on it 10, 20, 30 years from now, I think that will be looked back on as an inflection point. And I think it will be reflected on as a mistake that the United States did this. That's my belief. Now, whether that comes true, I don't know. But I think that's probably the case. But the point is that when that, but since that happened, there has been a lot of blowback, for lack of a better way of saying it, from the global South, right? And not only from the global South, but other entities, analysts, investors in the West have said, holy cow, that's a dumb move by the U.S. Now, nobody or people will think twice before they buy Treasury bonds or before they hold dollars, because if the U.S. can just take them from them, like a bully would just take it away, then, we can't trust you anymore. Okay. And I agree that's kind of an in-your-face, very brutal way to take somebody else's reserves. But what if you took $500 billion in reserves just by raising interest rates. There's not the blowback because it's not obvious, right? So again, think about, I would bet there's been more than 500 billion have been lost in reserve accounts around the world as the result from interest rates going from 0% to 5.5% than there was by us just taking it from Russia. And so, if people were to cash those reserves in now, they would lose more than Russia lost if they were to cash all those in. And so again, it's a way, it's not exactly like confiscating somebody else's reserves, but it kind of is. It's putting a liquidity, or I'm sorry, not a liquidity, but a valuation, decrease on their portfolio. And if you're decreasing somebody's reserves, is it really that much different than stealing them? I mean, if we dropped rates, those reserves would go back up. And we could take the money that we took from Russia and give it back to them. I mean, other than how you categorize them, are they really that different? And so again, I know there's people out there listening to this and say, this is not the way bonds work. This is not why the Fed raises or lowers interest rates. And listen, I agree. That's not their primary reason. But I don't think that they're as stupid as everybody else thinks that they are. And I don't think that they're blind to the fact that they can do this. And the fact is they have done it. So anyway, that's my story and I'm sticking to it.
Yeah, you do kind of have this, I guess, kind of like a time decay impact. It's almost, we would definitely do not have time to go down this rabbit hole right now, but it's kind of like an international CBDC. It's like a central bank digital currency.
That's exactly what it is. That's what it is, John. This is the thing. I'm so glad you said that. The dollar is already digital. This is and it all flows through a central location. It flows through the Federal Reserve and the Treasury Department, right? And they can say, boom, it's gone, just like that. Now, just like in a CBDC, if they said, boom, it's gone, there will be blowback. There will be people pissed off. Molotov cocktails will be thrown. Strikes will show up. Truckers will cross, shut down roads. But that doesn't mean that they can't do it. And, and that's kind of what they're doing. It's kind of what they did to Russia, right? And so, I think the real CBDC would just be an extension of what they're already doing.
Yeah, the difference here, going back to what what kicked off this conversation, is because of the volume of the holdings and the way that governments operate on the global stage, they're not holding cash, so to speak, right? They're holding the government bonds. Whereas citizens of the United States or of other countries where a central bank would have a CBDC, the influence that the Federal Reserve has by raising rates and therefore devaluing the bonds that these entities are holding, in theory, a central bank digital currency would have that same power over money itself. Again, not something we're gonna dive into, but when you understand kind of the functional components, like you're saying, the dollar's already digitized. They do have this power to kind of create almost like a time decay on it. Is it a stealth duality? Is it just a knock-on effect that maybe they realized after the fact that it had this power? Those are mysteries that we don't know, and we're certainly not going to try to solve here on the show. But
look, you stupid bastard, you've got no arms left.
Yes, I have. Look, it's just a flesh wound.
This show is provided for entertainment and informational purposes only. It should not be relied upon as legal, business, investment, or tax advice. Neither the hosts, guests, nor any funds they may manage intends to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies.